Okay. Okay, well, thank you so much for having me here today. And, you know, it's a perfect day for talking about option butterflies. So it's, you know, it's a high reward, low risk option strategy or trading strategy, and I also call it a low stress trading strategy. So, you know, with today's volatility and yesterday's huge up day and turnaround Tuesday, this is a good day to be talking about this type of strategy. So it's a 6-step plan I'll be going through today. The strategy itself, the most important option factor, how option pricing works, selecting the right butterfly option strategy, and showing you some trades and hedging using the butterfly trade strategy, and then how you can bring all this together. So back up. The following webinar here today is purely for educational purposes. Any stocks, options, futures, ETFs mentioned does not constitute advice and should not be construed as a recommendation. So a little background on myself. She gave a brief overview. Appreciate that very much. But yeah, I've been trading for over 30 years and was previously executive vice president for one of the largest oil trading companies in the world, Trans World Oil, and ran the international trading desk for over 10 years out of Bermuda. So had a lot of experience there trading a lot of the different markets, all the different derivatives and futures. And also we were one of the first groups to start trading options on crude oil, over-the-counter options. Went on to launch the institutional over-the-counter crude oil options brokerage desk for a company called PVM Oil London, and they're the largest privately owned oil brokerage company in the world. So, you know, my passion really is developed into options just because of all the various things that you can do with an option. And today we'll be discussing one of the strategies that is really just amazing, interesting strategy. So one thing too is that trading for yourself, you know, can be one of the most rewarding jobs, you know, on the planet, but you really have to stay educated about, you know, what you're trading, about what's working, and really stay focused on managing your trading risks. But it can also be very painful and stressful at times, as probably I'm sure everybody here can probably attest to. So that's why today I'm going to show you a strategy. It's one of my favorites, the high reward, low risk, and I also, like I said, call it low stress option strategy. It's the butterfly option strategy. So it is a high reward, low risk option strategy, and it can really help you to reduce market stress. So when getting tired of markets, you know, uncertainty like we've been having in periods of high volatility that can really start to weigh you down, there's a really great strategy that can give you a trading advantage in any type of market environment, and it's, again, what I call that low stress option butterfly spread. So this option trading in general, you know, has so many more advantages than trading stocks, but as you probably all know, it can also be a bit more complicated. And for the individual trader, options can also be intimidating at times. But the option butterfly is one option strategy that is really a must for your trading toolbox, you know, if you are a really serious trader and looking for different ways to diversify your trading risk for different type of market environments. So it's perfect for so many different conditions. So why trade the butterfly? Well, unlike other option strategies such as iron condors, credit spreads, debit spreads, butterflies are very dynamic, can be traded for a variety of different reasons with different goals in mind. So you can, you know, use these strategies for income. So it's a great way to generate income from stocks you think are going nowhere in the short term. So this can contribute to your overall portfolio returns in a flat market. So it's also non-directional. In their simplest form, the butterflies are a delta neutral, non-directional trade. So sometimes, you know, trying to pick directions of stocks or the overall market can also be very stressful and expensive. And delta neutral type butterflies can be set up to take the guesswork out of your trading. So it's a high reward, low risk option strategy that can be structured at a very low cost of capital at risk. So sometimes you can get a 10-to-1 or even higher reward to risk. This is pretty common on some of these balanced butterflies. So you have the directional butterfly as well, and the directional butterfly spread offers you a bullish or bearish exposure to the market while managing your risk and retaining you know, potential for large potential returns. So even though a butterfly spread cannot offer unlimited profit potential, they usually cost a lot less than buying outright and offer an amazing positive risk-reward trade setup. So they're also the perfect vehicle for hedging. And really trading is really about managing risk, and this is the best trading strategy I've found for hedging positions. So the directional butterfly can be used as a fast to execute hedge on positions that are moving against you. By constructing a butterfly, say around a strike that is currently under pressure from one of your core positions, such as you might have on a credit spread or a debit spread, this becomes a great defensive strategy for controlling and reducing your risk. And that is, something that can really lower your trading stress. So it allows you, what it does when you start hedging using a butterfly, it'll allow you to keep your original position open. And many times that's all you need is just for that trade, a little bit of time, and for that trade to redevelop and move back into your favor. So we've seen a lot of those particular situations, where you'll have a trade that's looking great and then all of a sudden it'll stall out, move against you, only to continue back in that direction. So this is a great strategy for hedging in the interim, waiting for that momentum to shift back. So at that point, you can then remove the butterfly hedge and stick with your original trade. So also long-term out-of-the-money put butterflies can also be a much cheaper method of portfolio protection than just pure longs. So it's also called low maintenance. Butterflies are sometimes referred to as the vacation trade because of their low risk and need for only very infrequent type of monitoring. So they can be put on, when they're initially put on, they're very slow moving early on, so you don't have to constantly be monitoring the trade. But as you get more, closer to expiration, then it starts getting more exciting, and the volatility that surrounds it, as it approaches expiration, and as it gets within its profit zone, starts to really speed up. So this is what we call, this is a look at a butterfly, the profile of a butterfly. It looks like a tent. So when you get inside this tent, we call that the profit tent or the profit zone. That's where you can start making some really good money on very low capital at risk. So step 2 then is the most important option factor for profit generation using the butterfly strategy, and it comes down to understanding the concept of time and its effect on the price of your option. So time value is used for trading strategies that take advantage of the accelerated time decay of an option into its expiration. And the butterfly strategy is very tied to time value. And the theta is what we can measure time value with, and its impact that it has on the price of that option. So what exactly is time value? Well, time value is also referred as the extrinsic value of the option, and it's the premium a rational investor would pay over its current exercise value, the intrinsic value, based on its potential to increase in value before expiring. So this probability is always going to be greater than 0, thus an option is always going to be worth more than its current exercise value. And the change in the value of an option based on time decay, we can measure that using the Greek called theta. So it's a really great tool that you can use to measure how the effects of time decay are affecting your option. So all that theta does, it tells you exactly how much an option, theoretically, an option's price will diminish over time. And that's the rate of time decay of that stock's option. And the time decay occurs because the extrinsic value or that time value of the option diminishes as expiration draws nearer and becomes smaller and smaller, and eventually will go to 0. So by expiration, options have no extrinsic value left, and all out-of-the-money options will expire worthless. And the rate of this daily decay all the way up to its expiration is estimated by this option theta value. So by understanding option theta, it becomes extremely valuable and important for the application of option strategies that seek to profit from this time decay. So the theta values are going to be either positive or negative. So just think all long stock option positions are going to have negative theta. So if you're long a call, if you're long a put, that has a negative theta value, so that goes against you, which indicates that they're going to lose value as expiration draws near. Now all short stock options, such as a short call or short put, will have positive theta values. So this indicates that that position is going to gain value as expiration draws near. So by knowing the relationships and how this affects your option price, is key to being able to select the right strategy for various market conditions. So again, theta value then is going to be highest at the money, at the money options, and it's going to get progressively lower as you go in the money or out of the money. And the in the money, out of the money options are then going to have a much lower extrinsic value, giving little time left to decay. So here's an example. Now, if you had an option contract that was showing an option theta, and this is all given to you on your option platform. So if you had an option theta value that was minus 0.10, you're going to be losing approximately $10 per contract every day, even on weekends and market holidays. So remember, one option contract is equivalent to 100 shares of stock. So, if that was to move, so 0.10 equals $10. So the buyer or holder, let's say, of an option contract over a 3-day long weekend, if you had bought that option at $1.40 on Friday or so, that'd be $140 per option contract. And the option theta, if it had a minus 0.10, you're going to find that the price theoretically of that option is going to be 110 instead of 140 after a 3-day long weekend. And that's what we call that decay, theta decay really strikes and hits based on that time decay. So if you're not aware of that, you'll come in and you see, wow, I paid $1.40, the market hasn't moved, and now it's $1.10. Well, you just got hit by that decay strike. So, option theta, again, it's not going to remain stagnant. So it's going to increase as expiration gets closer, and it's going to decrease as options go more and more in the money or out of the money. So in fact, the effects of option theta decay is most pronounced during the final 30 days of your expiration, and that's when it really soars. So here's an example just to show you that theta decay on a time graph here. So if let me get my pen. So if you have a option that you're 120 to 90 days out, like right in here, you're going to look at that option and you're going to look at the time decay, and it's going to be very, very gradual. You might not even see any time decay if you're really far out, and so it's pretty flat. But as you get 30 days out, close to expiration, or you start looking at those weekly options, before you know it, you're going to be at 0. So it really accelerates. And what's going to happen is if you're constantly buying options as you're getting closer to expiration, it's kind of like swimming against a swift current. It's going to be very hard for that for buying options to pay off unless you get a really positive hard move in the case of buying calls to the upside. So that's an important thing to understand, is that theta decay accelerates and it will eventually be 0 at expiration. So you've got to be aware of that and try to take advantage of it. So here's a look at Amazon theta values 7 days from expiration. So you can see the difference here of a theta. So here's the strike prices right here, and here you can see 7 days to expiration on Amazon. So here's it was trading right here on this example at 765. So if you look at that 765 strike, you'll see the theta is minus 39 cents, or almost minus 40 cents. So that's basically $40 a day. So if you had bought that call option, the 680 strike, and that would be, the 765 strike, and paid $680, if you could come in the next day, if the market was still trading at the same price as 765, this option would be now worth only 640 because of that theta decay, minus 0.39. You can see here the puts are about the same, minus 0.38. Now as you go in the money, so here's 750 to show you the example, you can see the theta decay is less. So the deeper in the money options are going to be less affected by the time decay. And here's the put value, 27 cents, as per the at the money. And if you go out of the money, here's a 785 strike. You can see the theta decay there is only minus 0.19 on those puts and calls. So in the money, out of the money, less time decay than at the money. That really kind of pretty much illustrates it. Now, if you go further out, so here's 40 days out on Amazon with the same price, you're going to see that there's less theta decay for further out in time. So here's that 765 strike here. You can come over and see that the theta decay is only 22 cents and the put side is only 21. So it's less than that 39.40 cents that we showed you on when you have 7 days, or right coming into expiration on a weekly. And if you go in the money, you can see it goes down even a little bit more, even on further out in time. And as you go out of the money, you can see it goes down even more. So the key takeaway, though, is that the at the money is going to have the highest amount of theta decay, and as you get closer to expiration, that's going to increase and increase and increase until it's eventually that option you bought, unless it's paid off, it's going to be down to zero. So then the next part of the puzzle is, well, then how does option pricing work? So by understanding how option pricing works, then you're going to, this will really help you as far as putting together what option strategies to look at and how to use those strategies. So the basic or main components for the valuation of an option will be taking the time value times its implied volatility times its underlying value, the intrinsic extrinsic value. And once you know these variables, then you're going to be ready to price that option and know what its option premium should be. So here's another table that we can use to illustrate how pricing works. So this table is based on a weekly option, and so every Thursday you have a new series that comes out. So when you have that first day, you're going to have 100% time. So time value times the implied volatility times the underlying value, which is the intrinsic extrinsic value, that gives you the price of the option, the premium. So we're going to keep this constant at 1 so you can see how these values affect each other. So the first day, 100% time, and if implied volatility was 300, then that's going to give you the $300 price here. Now, if you look down here to Monday, you can see that that time value has been now cut in half. So even if you increase the implied volatility to 800, keeping the underlying the same, you can see that your premium just went up to $400. Not that much of an increase from that day one. And then just think, if you had the same implied volatility of 300 here, then your option premium would only be 0.50 times 300 would only be $150. So you can see that, it's very important to be aware of that time value, what it's doing to your price of your option, and also be aware of implied volatility. So all these are going to be going to zero at expiration, so you need to be aware of how it's affecting the price of your option trade. Now, step 4 is selecting the right option butterfly strategy. And one major goal of every trader, in my opinion, should be to select trades based on what's going to provide you the most consistent positive returns with low defined risk, and not always the greatest return. And one of the best ways to achieve this is by knowing the various option butterfly strategies that are out there, and then how they work, and then selecting the one that's best suited for the market environment that you're trading in. So the different types of butterfly strategies are listed here. You've got the long call or put butterfly. You've got a short call or put butterfly. You've got what we call a broken wing. Sometimes it's referred to as skip strike call or put butterfly. You've got an unbalanced butterfly. It's also referred to as a ratio butterfly. Directional butterflies, iron butterfly, and then hedging, using it to defend a trade using what I call the defense of using the butterfly. So we're going to cover these particular types of butterflies, most of them anyway. I don't have time to go through all of them, but we'll go through the ones that I like to use the most. So here we'll look at some trades and hedging based on the butterfly, just so you can see how these work and can complement whatever kind of trading you're doing. So this is a directional option butterfly spread. So this is what's also referred to as a balanced butterfly. So in this example, they're great for ETFs and great for stocks as well. So this is on SPY, very liquid, ETF, good bid offer spreads on these options. And so this trade was what I call as a directional butterfly using the puts. And it was trading at the time at $202, looking for a target, just looking for it to move up to 205. Now this analysis was based on, I like to use Fibonacci for target price, and also I'll look at open interest analysis to help me look at target prices for where a particular stock can go. So this also had huge high open interest at the 205 strike. So I wanted to set up a trade just to go to 205. So you can see a very short duration trade put on it on the 15th, taken off on the 18th, and it was at 204.55. So the other thing I like to do is always know, base these kind of trade setups on Fibonacci as much as I can. So here is just taking a high to low swing and looking for the Fibonacci target extensions to the upside. And right here was a 1618 extension coming in right a little over 204, and then the high open interest at the 205 gave a really good target to trade, to set this trade up for. So you're going to see these are very low cost, very low capital at risk type trades in certain situations. So this was setting up a long put butterfly. The market was trading at 202. I was looking for a target at 205, and it's just $1 wide. So you can see this went long the 206 put, short a 205 put, and then short a 205 put, long a 204 put. So it's basically two vertical spreads put together. Now, when you combine these two spreads together, that's what creates this balanced butterfly. And on this particular trade setup, the max at risk was only $14 per option contract. So if you did nothing at all, and you were totally wrong on this trade, you'd only lose $14 per option contract. So the profit on this is the dollar difference. So it's a dollar wide spread. So $100 minus your cost gives you your max theoretical profit of $86 per option contract. Now, if that happened and you could get it exactly like that, which you'll never get it exactly like that, that would be over 600% return, 6 to 1. But think about it, if you can just get, 30%, 40%, 50% of that $86 in a 2 to 3 day period, that's a great return. So you can see in this situation here, this one actually made $37 per option contract over 3 days, and that's a 265% return just based on your capital at risk of 14. So here's what the trade looked like down below. It's buying the 206, selling the 205 put spread, vertical put spread, and then selling the 205, buying the 204 vertical bull put credit spread. So two different vertical spreads put together, 14-cent debit, the difference potentially $86. And this is that profit zone. You can see it looks like a tent, and you'll get your max potential profit right at expiration, right towards the end of the day, because what it's doing is stripping out all the time value that's left in the option and all volatility. So eventually, everything is going to go to zero. So if you can get it right to pin right on your, your target price, then it strips out all that time value, time decay, and implied volatility, and that's where you can really make a lot of money on a very low capital at risk. So this one actually paid off $37. And if you'd done 10 contracts, that's $370 and a risk of only $14. So turns out that's a 264% return, very low capital at risk of 14. So I like those kind of risk-reward odds. Now here's my personal favorite. This is what we call the unbalanced or ratio butterfly. So you can do it with puts or calls, and you do it with puts if you want it to kind of skew it to a directional upside move, and you would do calls if you wanted to skew it to a downside move. So this was a directional trade set up on Facebook, and this is what I call volatility breakout, and I was looking for a move again based on Fibonacci up to a target price of 130. So these dots represent what we call a volatility squeeze. These are my momentum indicators, so I like to trade momentum, and you can see a trend line here. So the trend line break here, and we set up before it broke a butterfly at this 130 strike, and it was an unbalanced butterfly. So the market was trading at 126.50, set that trade up before that breakout, and the idea was to take it off if it got to 130. So here's, again, using Fibonacci to help with price targets. So here's that high to low, and this gives you your 1272 extension right here and your top extension at 132. So this trade actually broke out, and it went right to that first target and blew right through it. So it was perfect because we had the target here at 130, so it hit that target and get out of the trade. So here's what that trade looks like. You'll see it's very, very low capital at risk at times, so you can put these on. So this is a put ratio butterfly, and this trade was on just for 5 days. So set this trade up and received, this is the beauty of it, received a $75 credit the way this was structured. So that puts, it was a dollar wide spread. You can see down below 131, 130, 129, so dollar wide spread. So the maximum risk would just be the difference of $25. So that's the maximum at risk. Now the max potential profit theoretically would be 175, and that would be a 700% return. The advantage is that it's got a positive theta decay and very low capital at risk. So this actually turned out to make $55 per option contract, and that's a 220% return in 5 days. Now if you just bought the stock, that would have been a 3.90% return. So you can see the huge leverage advantage that you get with these structures at a very low capital at risk as well, lower than what you would do if you bought the stock or even bought the calls outright. So if you notice the spread trade set up here, you'll see that it's, again, two vertical spreads. So it's the, buying the 131 put, selling the 130. Okay, so here's a vertical put debit spread, and then you're selling two bull put credit spreads. So you're going to sell two of the 130, 129. So that total is 3 at that 130 strike or the body. And this setup at this time, the market pulled back and we're able to get filled here at 75-cent credit. So max theoretical profit would be 175, max at risk 25. So like the odds, if you're wrong, it's maintainable to lose $25. So it went up to that 130 strike and beyond. So when it hit that 130 strike, it actually went to 130, 150, took the spread off, and it made $55 per option contract versus the max, but that's good enough. That's still a huge return, and this was over just I think a 3-5 day period. So 5 contracts on something like that, it's $280 real quick with very low risk. Now here's another way that it can work out where you can, at the same strike, you'll see how you can get two different profits, and it just comes down to time decay giving you your max profit. So this is pretty interesting if you look at this. So this was on NVIDIA. This was towards the end of September, and it's again what we were calling a volatility squeeze. So we're looking for a break to the upside, and we're looking for just a target price of $65. So these are very short duration trades. So put on the 21st, and then the expiration is 23rd. So took it off the 22nd, 23rd. So just looking for a break to the upside to that target, and again using Fibonacci and using options, the expected move. So you can see here the Fibonacci level was that 1272 extension at 65. So that was our target, just for a quick move up. But you'll see that how these are structured, that just even little tiny moves up can give you a great return. So here was the trade setup, and this was again what we call a put ratio butterfly. So the credit received on this one was $29, so that puts your risk at 71, a little bit more risk, but the way it was structured with such short duration, it looked great at the time to still do it. Now the max profit would be 129 theoretically, so that'd be 181% return. Okay, advantage, positive theta, and very low capital at risk. So the next day it shot up, hit that target of 65, so it took off part of the trade at $44. Okay, so that's a 62% return in one day. If you just done the stock, that would have been 1.5% return. Held on part of it for Friday's expiration on the 23rd, and it went almost pinned to the penny, or to at 65. And look at the difference in profit. This actually on Friday went out at a lower price than it did on Thursday, the 44. But because of it stripping out the theta decay and time value, the profit went to 119 per option contract, or 167% return. So here's what the two look like. Here's the risk profile of that unbalanced ratio put butterfly on the 22nd. So you can see that purple line in here. It's not all the way to the top of that tent, but here's your profit area here. So this was taken off with $44 profit, and on 5 contracts that's $240. Now left the balance for the next day to see if we could possibly get a better pin at 65. And see the profit 10 here. See that purple line is almost exactly to the teal color, which is the underlying value. And based on that, you can see that this went from a 29-cent credit down here to a 90-cent debit. So that's pretty neat. So from a 29-cent credit to 90-cent debit, and that was the 119. So that would be over $370. So very low risk type, capital at risk type trade setup with very, very high potential return. Now here's the other key part of using a butterfly, and that's trades. You can use this to defend any kind of vertical spread. So you could do it for credit spreads, or you could use it to defend a debit spread. So this is the original position I'll show you here, was a short bear call credit spread on SPX. And again, it's what we call kind of a price divergence, momentum divergence trade. So SPX was trading here at 20.55, and momentum, you can see down below, cycle, these are my cycle indicators for momentum, were negative. So, you know, I was looking for either a sideways move or a move lower. Now, every time when you put on a trade, I always tell my members, clients, to make sure you have a defense. What are you going to do if the trade goes against you? Where are you going to stop out, or where are you going to defend it? So in this particular trade, my defense, and I call this the post line in the sand, was going to be 2070. So if SPX was going to start moving back above this 2070 level right here, then I'd have to either stop out or I could hedge it, and I was going to hedge it with the butterfly. So here's the original trade. It was an out-of-the-money bear call credit spread. Here's where it was trading on that day, the 5th, at 20.55. So sold the 20.85.90 bear call credit spread out of the money up here, almost 1 standard deviation. And so here's trade 1, selling the bear call credit spread for expiration the 21st. So sold the 20.85.2090 bear call credit spread. It was set up at approximately 1 standard deviation out of the money. So statistically, that gives you a potential 68.2 winning probability when you're doing a 1 standard deviation move out of the money. So the credit spread received 105, but it puts your risk potentially, if you're wrong, at 395. So it's a negative risk reward. But that's how credit spreads are. But the reason they are is because you're getting a higher probability of winning. So that would be a 26% return, if the spread closed, below your short strike. So still, these are great type of return trades to do. So here's the credit, $105. Here's the trade, 20.85.2090 bear call credit spread. Now, it did start hitting my line in the sand, the 2070. So I had you don't hesitate when it hits your plan is set in motion where you have to take action. So in this situation, it was either stop out, or what I ended up doing, what I like to usually do on these types of trades, is just convert it to a butterfly. So to do that, I just bought the 2080 calls, sold the 2085 as a call debit spread, converts this to a butterfly. So here's what that looks like. So when it was crossing the 2070 that day on the 13th, went and placed a long call debit spread, 2080-85 debit spread. So cost $230 per option contract, so premium paid $230 as your risk. Potential profit would be $270. So now I've got a credit spread on plus a debit spread, and what that does, that is a butterfly. So a vertical credit spread and a vertical debit spread together sharing the same body creates the butterfly. So the original trade, short call spread, 20.85.90, collect $105 credit that goes into the bank account, hedged it by buying the debit spread, 20.80.85, had to pay $230. So the difference is I reduced my risk down to 125. So I paid $230. I already had a credit 105. So now my risk went from a 395 potential loss on that original credit spread to $125. So if it goes down or up above the strikes, the long strike, you would lose only 125. So that really caps and neutralizes your risk. Now, if it closes here in the middle, you make a ton of money, or you can leg out of the spread. So that's why I call it a low-stress kind of hedging strategy. So you can see that it just blew to the upside. So always have a line in the sand, post line in the sand trade set up. What are you going to do if it hits a certain price? And this one just continued up to the upside, eventually going up to 20.97. Now, I ended up legging out of the spread. And I'll show you then, this is something else you can do. So I used like a 5-minute chart, and I legged out. So as it spiked up that 20.97, what I usually do, I'll sell off the long call debit spread first. So in this case, sold that off. So that spread was bought at $230. Now it went all the way up, max profit of $500. It just blew to the upside over that 20.85 strike. So this made $270 profit. Now, then I had the short bear call credit spread on at 105. Now, as this shot up, I was looking for a little bit of a pulled back intraday, which I got, and then I just covered this credit spread, took that off, closed that out, and close that out at 350. That then $45 per option contract. But you can see the difference, 270 on the debit spread minus 245 on the credit spread. So ended up making $25 versus losing $395. So that's the name of the game, is always in and have a kind of a campaign if you're doing selling credit spreads where you never want to lose your max potential at risk. So this one turned out actually really great by doing that strategy. Buys you time, then you can figure out what you want to do. So wanted to just get in today to show everybody here how to take advantage of this simple but really amazing strategy for all kinds of different market conditions. And if you'd like to learn more about this option strategy, I'm going to show you a really great package I put together for everybody here and how you can bring this all together and really start helping your trading. So this is an option, the Amazing Option Butterfly Trading course that I did back about 2 months ago, and now it's on demand. So it was a 4-hour plus course. So you're going to get this today, the whole course on demand, 30-minute modules, and 213-page PowerPoint training manual. So you'll get all that. Here's the link, and then I've got some great bonuses for everybody here, the first 30. So it's going to be a 5 enrollment bonus package today for the first 30. So let's go through the package, and then I'll go through what's in the course. So here's the link again. It's powercycletrading.com/BEST. So you're going to get the access to the 4-hour on-demand butterfly course. This is for sale on my course. If you decide later that you don't want it today and you come back, it's $197. Then we're going to do a live follow-up support Q&A. So this will be probably 2 weeks from now, so you'll have plenty of time to go through the course. We'll send out an email to you when that will be. It will also be recorded, and you'll get the PowerPoint of that. And then I'm going to give you my complete option strategy manifesto. This is 15 option strategies. You can print it out, put it on your desk. And then my Greek power tool guide. This is all the Greeks, so you can also print that out, put on your desk. And for anybody that's never been a member to my trading club, I'm going to also give you one free month membership, trial membership to my club. And if you decide to stay in it, then it's $97 a month. So great value for everybody here, first 30 today. I want to keep the group small enough. And so you'll get the on-demand recorded course in 30-minute modules, and this comes with a really detailed training manual. My courses are very, very detailed. If you've ever taken one in the past, you'll know that that's the case. And the great thing, too, is zero risk. If you're not happy with the course, just send us an email. We'll be happy to refund your money. So it's a win-win situation for you. If you want to check out the butterfly spread, I think you're going to really find it a fantastic strategy to add to what you're doing currently, or you might decide this is the only way you want to trade. So you're going to get the step-by-step course, Trading Option Butterfly Spreads. It's a 4-hour course broken down in 30-minute modules, so it's easy for you to go back and forth, and you get the full PowerPoint 213-page training manual, live follow-up Q&A. This is the option strategy guide, so it shows you the different diagrams of the profile of various covered calls, ratio, butterflies, protected puts, and description of what they are. You can put that on your desk. And then here's a desk reference guide for the option Greeks. It's a really good guide there. And one free month to my trading club if you've never been a member. So all that for this one price of just $97 today. And I look forward to working with you. Now in the course, we're going to cover the core basics that many traders miss when using butterflies. We're going to teach you why to use the butterfly, which Greeks are vital and how to use them with the butterfly, then how, why, and when to use the long call or put butterfly, the broken wing butterfly, ratio butterfly, directional, iron butterfly, and vacation butterfly. So I go through all these in very detail, great detail in the course, the optimal times to capitalize on these different butterfly strategies, and then the structure where you can structure these things for these really high return on low risk, 10 to 1 or higher. The ratio butterfly is my favorite because it's such a great directional trade. Instead of just doing long calls or long puts, you can set up the butterfly, lower cost of capital. And if you just think back to that one trade I showed you on NVIDIA, where on the day after the spread was put on, it went to $65, it made 44. but the next day when it was going out of expiration, it made 119. So that's the beauty of it, because you're short more options than you're long. You're taking advantage of the theta decay being stripped out and volatility being, going to zero. So it gives you a different advantage than a normal trade. Then how to profit from the option volatility collapse and theta decay. That's what happened on that NVIDIA trade. If you think it was the volatility collapse going to zero and theta decay going to zero, so it really spiked that profit. And then how to use pinning. This is a great thing to understand, and this is option expiration. How to actually analyze to know where a potential stock can go out based on its open interest, and how to target the optimal option expiration pinning strike so you can use these butterflies to profit from those pinning type of moves. And then price target setups for butterfly using Fibonacci technicals. So a very key component of this is your targets, how to set up your targets for any trades you take using some Fibonacci analysis, plus the expected move of your options can tell you great target zones and step-by-step checklist, then how to execute and manage the butterfly. And then the big part here, if you don't want to do ever a butterfly, but I would highly recommend that you learn more about the butterfly spread defense for defending your vertical debit or credit spreads. This is well worth the course 10 times over. So this will really help you if you just learn this one simple way to use the butterfly to defend a trade. So it'll help you to defend any kind of core position by using the butterfly as your hedge. Now our trading room's open every day from 9:10 a.m. till 4:15. I'm in there first hour and a half in the morning, and then for the last hour we do all kinds of different trade setups in the room, from futures day trades to trades like this to other swing trade setups to seasonality type trades. I like to trade momentum and breakouts, so we do a lot of that. We do a live Q&A every week, so you get to come to that, ask whatever questions you want. We have a Trader's Educational Vault. We have monthly award points, $20 credit for every month that you're a paying member. You can use these against courses in the future or my trading model, and you'll get discounts and priority access on all courses and all of our trading models. So I've got a lot of trading models I've developed that you'll also have access to. So it's a really great course, and I've had a lot of my members very happy and very successful with it, and hopefully I feel comfortable and confident that you will too, and if you're not, you get a money back guarantee. So that's pretty much it. Hopefully this is something that you'll have an interest in, and if you want to try it out, here's a great way for you to try out the butterfly. But even if you don't want to use a butterfly for your trading, if you learn how to use the butterfly hedge for just your core positions, it's going to make a huge difference in your trading performance. So I'll leave it there. I appreciate everybody being here today, and good luck trading tomorrow, and I guess my time is up.